Something happened yesterday that changes everything about what Monday morning looks like for your money. And the reason it changes everything is because the data landed on the one day of the year when no one could do anything about it. On Friday, April 3rd, 2026, the United States Bureau of Labor Statistics released the March jobs report. 178,000 jobs added. Unemployment ticked down to 4.3%. On any normal Friday, Wall Street would have had 6.5 hours to digest those numbers, to trade on them, to price them in. But Friday was not a normal Friday. Friday was Good Friday. The New York Stock Exchange was closed. The NASDAQ was closed. The bond market shut down early. Every single cash equity market in the United States of America was dark. The most important economic data release in months landed in a room where nobody could move. No buying, no selling, no hedging, no reacting, just silence. And behind that silence, right now, this weekend, as you're watching this, the largest and most sophisticated financial institutions on earth are running their models, adjusting their algorithms, recalculating their exposure, and preparing for what happens when the opening bell rings on Monday, April 6th. I need you to understand something. What happens on Monday is not just about the jobs number. The jobs number is the detonator. But the explosive has been building for weeks, and the people who move the most money in the world already know this. They have been positioning for it since January. They have been hoarding cash at the fastest rate since a global pandemic shut down the planet. They have been quietly exiting the trades that made them rich for 3 straight years. And they have been doing all of it while telling you on television that everything is fine. Stay with me, because what I am about to show you is the documented, verified, exposed reality of what Wall Street is preparing for right now while you are sitting at home on a Saturday thinking the worst is behind us. Let me start with the jobs report itself, because the headline number is a trap. 178,000 jobs sounds strong. It sounds like a recovery. It sounds like the February disaster was a one-time event. That is exactly what it is designed to sound like. Here is what the number actually tells you when you look beneath the surface. February was revised down from a loss of 92,000 jobs to a loss of 133,000 jobs. That means February was not just bad, it was 44% worse than originally reported. The economy did not lose 92,000 jobs in February. It lost 133,000. That revision alone should have dominated every financial headline this weekend. It did not, because the March headline number was big enough to distract from it. Now look at where the March jobs came from. Healthcare added 76,000 positions. That sounds impressive until you understand that 35,000 of those jobs were physicians returning from a Kaiser Permanente strike that had temporarily suppressed February numbers. Those are not new jobs created by a growing economy. Those are workers who went on strike and came back. Strip the strike effect out of the healthcare number, and the real organic job creation in March dropped significantly. Average hourly earnings rose just 0.2% for the month. Economists expected 0.3%. The annual wage growth rate fell to 3.5%. That is the lowest reading since May of 2021. In an economy where inflation is running above the Federal Reserve target, workers are earning less in real terms with each passing month. The average work week declined to 34.2 hours. Hours worked are shrinking. When employers cut hours before they cut headcount, it is one of the most reliable early indicators that layoffs are coming. The labor force participation rate sat at 61.9% unchanged and stuck well below pre-pandemic levels. Long-term unemployment, people out of work for 27 weeks or more, hit 1.8 million. That number is up 322,000 over the past year. The number of discouraged workers, people who have simply stopped looking for employment, jumped by 144,000 in a single month to 510,000. These are people the unemployment rate does not count. They have given up. They are invisible in the headline number. And the broader measure of unemployment, the U6 rate, which includes discouraged workers and those holding part-time jobs for economic reasons, edged up to 8%. 8%. That is not a healthy labor market recovering from a temporary setback. That is a labor market fracturing in slow motion, while the headline number provides cover. But here's the part that makes Monday genuinely dangerous. The market did not get to react to any of this on Friday. In a normal month, traders would have had an entire session to process the data, to adjust positions, to buy or sell based on their interpretation. Instead, the data dropped into a vacuum. And over the weekend, every institutional trading desk, every algorithmic system, every hedge fund risk model has been running scenarios. By the time Monday morning arrives, there will be 48 hours of pent-up analysis, 48 hours of revised models, 48 hours of repositioned futures contracts, all trying to execute simultaneously in the first minutes of trading.
This is not a speculation about what might happen. This is the documented mechanical reality of how markets behave after data gaps. When significant economic releases occur on market holidays, the following trading session experiences amplified volatility. The price discovery that would normally happen gradually over hours gets compressed into minutes. And in the current environment, with the conditions I'm about to show you, that compression could be explosive. And this is not the first time the market has faced this exact mechanical trap. Let me take you back to April of 2025, almost exactly 1 year ago. The so-called Liberation Day tariff executive order triggered a cascade that nearly crashed the market. The S&P 500 fell close to 20% in 7 weeks. Institutional investors now explicitly reference that event as their playbook for 2026. They remember what happened, they know the pattern, and they are positioning based on that memory right now, this weekend. But the current situation is structurally worse than April 2025 for one critical reason. Last year, the shock was a policy decision. A tariff can be reversed with a phone call. A war cannot. The conflict with Iran is a kinetic military operation involving the United States, Israel, and multiple Gulf states. The Strait of Hormuz, through which 20% of the world's crude oil supply flows, has been effectively disrupted. Ships are not transiting. Insurance companies have pulled coverage. Kuwait has declared force majeure for the first time in decades. Iraq has slashed production by 1.5 million barrels per day. This is not a policy lever that can be pulled back. This is a physical disruption to global energy infrastructure that takes months to restore, even after hostilities end. And the jobs report that just landed adds a critical new variable to every model running this weekend. Because the number was stronger than expected, coming in at nearly 3 times the consensus forecast of roughly 60,000. On the surface, that kills the argument for emergency rate cuts. A strong jobs number gives the Federal Reserve cover to do nothing, and doing nothing in the current environment means leaving interest rates elevated while oil prices crush the consumer and the economy slides toward recession. The Fed wanted a weak jobs number. A weak number would have justified cutting rates, easing financial conditions, providing relief to a stressed economy. Instead, the data gave them the opposite: strength on the surface, deterioration underneath, and no room to act. This is the exact combination that creates the most dangerous trading sessions. Not bad data, not good data. Ambiguous data that can be read in multiple directions simultaneously, forcing every participant in the market to make a directional bet with incomplete information. And every single one of those bets will execute at the same time Monday morning. Let me show you the broader environment those Monday trades are walking into. Because the jobs report did not land in a calm market. It landed in a market that is already cracking along every measurable dimension. Simultaneously, the S&P 500 closed the week at roughly 6,582. That is down more than 8% from its January high of approximately 7,000. The Dow Jones Industrial Average has fallen about 8%. The Nasdaq Composite has dropped more than 10%, officially entering correction territory. And the S&P 500 broke below its 200-day moving average on March 19th for the first time in over a year. That line matters because it is the most widely watched technical indicator in professional trading. When the index trades above it, institutional models classify the market as being in an uptrend. When it breaks below, the classification flips to a market in trouble. Every quantitative fund, every momentum algorithm, every trend-following system recalibrates when that line breaks. And it broke 3 weeks ago. The selling since then has been systematic. Now look at valuations. The Shiller cyclically adjusted price-to-earnings ratio, which is the most reliable long-term valuation metric in over 150 years of financial data, currently reads approximately 39.7. Let me put that number in context. In the entire recorded history of the American stock market going back more than a century and a half, there has been exactly one time when this ratio was higher. That was 1999, the final months of the dot-com bubble, right before the S&P 500 lost 49% of its value over the following 2 years. The current reading is not close to the danger zone. It is in the danger zone. It is the second most extreme valuation level ever measured. And Monday morning, a market sitting at that valuation level will have to absorb 48 hours of delayed reaction to the most complicated jobs report of the year. But the jobs report is not the only pressure building behind that Monday open. The war with Iran that began on February 28th has fundamentally altered the energy landscape. Brent crude oil spiked to $119.50 per barrel. West Texas Intermediate hit similar levels. Oil is pulled back from those peaks on verbal reassurances from the White House, but as of this week, it remains above $111 per barrel. That is more than 50% above where oil was trading before the conflict began, when Brent sat just above $72. Every recession since the Second World War, with only the brief pandemic exception, has been preceded by a major spike in oil prices. This is not a correlation, it is a causal mechanism. When energy costs surge, they function as a tax on every business and every household simultaneously. Transportation costs rise, manufacturing costs rise, heating and cooling costs rise, food prices rise because diesel powers every link in the agricultural supply chain. And consumers, who were already stretched before the war started, cut spending in response. That spending reduction flows directly into corporate earnings, and corporate earnings drive stock prices. President Trump stated on Thursday that the conflict with Iran could last weeks. His defense secretary, Pete Hegseth, said the war continues until total defeat. Iran has said it can sustain combat operations for 6 months. Saudi Aramco warned of catastrophic consequences if oil flows do not resume through the Strait of Hormuz. These are not signals of a quick resolution. These are signals that the energy shock currently embedded in the economy is not temporary. It is structural, and it is ongoing. Now let me show you what the people who manage the most money in the world are actually doing with their own portfolios, because this is the data that tells you more than any headline, more than any pundit, more than any government report. The Bank of America Global Fund Manager Survey for March 2026 is the most important sentiment document published this year. 210 institutional fund managers overseeing $589 billion in combined assets were surveyed. The results were a seismic shift from just 2 months earlier. Cash allocations among these fund managers surged to 4.3%. In January, that number was 3.2%, the lowest level ever recorded in the history of the survey. In 60 days, institutional investors went from holding the least cash ever recorded to executing the largest cash buildup since March 2020, when a global pandemic was shutting down the world economy. That is not a minor repositioning. That is an emergency defensive pivot executed at institutional scale. Global growth optimism among these same managers collapsed. In February, a net 39% of respondents were optimistic about global growth. By March, that number had fallen to a net 7%, a 32-point drop in growth confidence in a single month. Inflation expectations simultaneously exploded from a net 9% in February to a net 45% in March. Think about what those two numbers mean together. Growth expectations collapsing while inflation expectations surge. There is a word for that combination. It is called stagflation, and stagflation is the single most destructive macroeconomic environment for financial markets because the central bank cannot fight both problems at the same time. If the Federal Reserve cuts interest rates to stimulate growth, it risks accelerating inflation. If it raises rates to fight inflation, it risks tipping the economy into deeper recession. The Fed is frozen, and every professional money manager in the world knows it. The composite sentiment gauge in the survey fell from 8.2 to 5.6, a 6-month low. Fund managers identified geopolitics and inflation as the dominant tail risks, replacing AI bubble concerns that had topped the list for the previous 12 months. And critically, private credit was identified as the most likely source of a systemic credit event at a record proportion of respondents. The Bank of America Bull and Bear indicator fell to 8.5. Michael Hartnett, the bank's chief strategist, wrote that the frothy bull sentiment of recent months has ended. The era of unbridled risk-taking is giving way to one of caution and recalibration. His exact framing was the great de-risking when the people running $589 billion simultaneously build cash at pandemic speed/growth expectations and rotate from cyclical sectors to defensive positions. They are not responding to fear. They are responding to data that you and I do not see until weeks later. They have access to real-time capital flow information, to proprietary economic models, to direct intelligence from corporate boardrooms. And what that intelligence is telling them right now is serious enough to trigger the fastest defensive repositioning in 6 years. Goldman Sachs published its own data showing that hedge fund gross leverage reached the highest level on record by the end of 2025. Net leverage sat near 3-year highs entering 2026. And then it happened. March 7th and March 10th of 2026 are now documented as one of the worst 2-day stretches of hedge fund performance in years. Goldman's own internal analysis described it as multi-strat-nageddon. A momentum factor experienced a 4+ standard deviation drawdown, forcing systematic de-risking across multiple hedge fund strategies simultaneously. That is the kind of event that happens once in a decade. It happened 3.5 weeks ago. and the forced selling that followed cleaned out a significant portion of leveraged positioning across the industry. But here's the critical detail. Cleaned out does not mean resolved. It means the system absorbed a shock, and systems that have just absorbed a shock are more fragile, not less, when the next shock arrives. Monday is the next shock. Now, let me connect this to what Moody's is signaling because this is the data point that should be keeping every financial professional awake tonight. Moody's artificial intelligence-driven recession forecasting model, which has been backtested against 80 years of economic data, currently reads 49% probability of a United States recession within 12 months. In every historical instance where this model crossed the 50% threshold, a recession followed within 1 year. The model has never produced a false positive above that line. 100% accuracy above 50 and the current reading is 49, one single data point below the line. And critically, that 49% reading was calculated before the full known impact of oil above $100 was incorporated into the model. Moody's chief economist Mark Zandandi stated publicly that if oil prices remain elevated for more than a few weeks, a recession will be difficult to avoid. Oil has been elevated for over 5 weeks now. The consumer is already showing the damage. The University of Michigan Consumer Sentiment Index fell to 55.5 in March, the lowest reading in 3 months. Households with middle and higher incomes, those with stock market exposure, experienced the steepest drops. Year ahead, inflation expectations surged to 3.8%, the largest monthly increase since April of 2025. The Pew Research Center reported in February that 72% of Americans hold a negative view of the economy. Consumer credit card debt has crossed $1.13 trillion at an average interest rate above 21%. The personal savings rate sits at just 3.5%, and 45% of Americans told pollsters they could not cover an unexpected $400 expense. This is the consumer that Monday's market is pricing for, a consumer who is already drowning, a consumer who just watched oil spike above $119, a consumer whose wages are growing at the slowest pace in nearly 5 years. While prices continue rising, the Federal Reserve cannot help. Core inflation remains stubbornly above the 2% target. The tariff rate is at 16.9%, the highest since 1932. The war has added a supply shock on top of an already sticky inflation environment. Jerome Powell said in late March that policy is in a good place to wait and see. That is central bank language for we are paralyzed. The Fed cannot cut rates without fueling inflation. It cannot raise rates without crushing what remains of economic growth. It is standing still while the building burns. Let me walk through what the major banks are projecting because even the optimists on Wall Street have materially downgraded their outlook. JP Morgan cut its year-end S&P 500 target from 7,500 to 7,200. That sounds like a modest revision until you realize their near-term downside scenario puts the index at 6,000, roughly 9% below where it closed this week. Goldman Sachs maintained its year-end target at 7,600, but laid out a bear case scenario where the S&P falls to 5,400. That would represent a 23% decline from the January peak. A 23% decline would officially constitute a bear market. Bank of America's Michael Hartnett stated the market is approaching what he called a buyable washout, but wants to see levels below 6,600 before committing capital. Morgan Stanley's technical analysis identifies potential stabilization near 6,400 to 6,500. Every single one of those projections implies the market has further to fall from current levels before it finds a floor. And there's one more accelerant that most people are not connecting to Monday's open: private credit. The $2 trillion shadow lending market that has become the single most crowded institutional trade of the past 5 years. In the Bank of America survey, fund managers identified private credit as the most likely source of a systemic credit event at a record proportion. That is not a casual observation. That is the majority of professional money managers, pointing at a specific sector and saying, this is where the next break happens. BlackRock blocked nearly half of withdrawal requests from its $26 billion private credit fund in early March. Blackstone faced $3.8 billion in redemption demands. Morgan Stanley saw repurchase requests, hitting nearly 11% of its private income fund. Moody's downgraded a flagship KKR private credit fund to junk status when the world's largest asset managers are simultaneously deploying withdrawal gates, when a major rating agency is slashing credit ratings on funds managed by the most prestigious names in finance, and when 210 professional money managers independently identify the same sector as the systemic risk. You're not looking at an isolated problem. You're looking at a contagion vector. And if any of those private credit funds announce additional write-downs or gate extensions this week, the impact will land directly on top of Monday's already fragile open. The private credit market is connected to everything. Pension funds are invested in it. University endowments are embedded in it. Wealth management platforms have packaged it for ordinary investors as a stable income alternative. When private credit funds freeze redemptions, the institutions that invested in them cannot access their capital. When those institutions need cash, they sell what they can sell, and what they can sell is public equities, your stocks, your index funds, your retirement account. The selling pressure from a private credit liquidity crisis does not stay contained in private markets. It radiates into public markets at the speed of electronic trading, and it hits every ordinary investor who has no idea the risk was ever connected to their portfolio. And now the question that matters most. What do you actually do with this information between now and Monday morning? Because understanding the pattern is only valuable if it translates into action, and the window for action is closing. First, understand that Monday's opening minutes will be the most volatile of any session in weeks. 48 hours of accumulated positioning adjustments will compress into a narrow window. If the market interprets the jobs report as strong enough to prevent rate cuts, stocks could sell off on the expectation that the Fed remains frozen for longer. If the market focuses on the downward revision to February and the slowing wage growth, it could rally on renewed rate cut hopes. Both reactions are possible. Both could happen within the same session. The volatility itself is the certainty. The direction is not. Second, recognize what institutional money has already done. Cash at 4.3% growth optimism, at 7% inflation fears, at 45% defensive rotation into healthcare staples, and cash away from consumer discretionary and cyclical sectors. The professionals have already moved. The question is whether retail investors, the people watching this right now, have done the same. History shows they have not. In every major market transition in modern financial history, institutional money repositions first. Retail money follows weeks or months later, and by the time retail investors react, the professionals are already positioned to buy what retail is selling. Third, the oil shock has not been resolved. It has been temporarily repriced on verbal assurances, but the Strait of Hormuz remains disrupted. Production cuts remain in effect. Insurance companies remain unwilling to cover tanker traffic through the Gulf, and the secondary effects of the spike, the grocery inflation, the shipping cost increases, the diesel surcharges, these take months to work through the economy. Regardless of what crude oil does tomorrow, the damage is already in the pipeline. Fourth, gold is telling you everything you need to know about how serious this moment is. Gold reached an all-time high of $5,595 in late January. It pulled back during the initial chaos of the conflict, but has stabilized in the range of $4,600 to $4,800. Central banks globally have been accumulating gold at record pace. When every major central bank in the world simultaneously increases its gold reserves, it is not because they are speculating. It is because they are hedging against the exact scenario that is now unfolding. Currency uncertainty, geopolitical disruption, inflation that central banks cannot control. Fifth, understand the calendar ahead. Next week brings the release of the FOMC meeting minutes, fourth quarter GDP data, the Consumer Price Index for March, and the University of Michigan inflation expectations for April. Each one of those releases has the potential to move markets significantly on its own. Together, they create a gauntlet of potential volatility events landing on top of a market that is already fragile, already nervous, already positioned for trouble. The March CPI number is particularly dangerous because it will be the first inflation reading to fully capture the oil shock that began on February 28th. If headline inflation spikes above expectations, the last remaining hope for rate cuts in 2026 evaporates completely. And if rate cuts are off the table while the economy deteriorates, you are in a stagflationary trap with no policy exit. Sixth, do not confuse last week's bounce with a bottom. The S&P 500 posted its first weekly gain since the war began, rising 3.4%. The Dow added nearly 3%. The Nasdaq surged 4.4%. That sounds like recovery. It is not. It is a relief rally inside a larger downtrend. The index remains below its 200-day moving average. It remains more than 8% below its January peak. And the conditions that drove the decline, the war, the oil shock, the inflation, the frozen Fed, the private credit stress, none of them have changed. Relief rallies inside bear markets are historically some of the most dangerous traps for retail investors because they create the illusion that the worst is over, while the structural deterioration continues underneath. In 1929, the market rallied 48% after its initial crash before declining another 80% over the following 2 years. In 2000, the S&P bounced repeatedly during the dot-com collapse, producing multiple relief rallies that convinced investors the bottom was in. Each rally was a trap. The market ultimately lost nearly half its value. In 2008, Bear Stearns collapsed in March. The market rallied through May. Investors breathed a sigh of relief. Then, Lehman Brothers filed for bankruptcy in September, and the index fell another 40% in 5 months. The pattern is always the same. The first leg down produces fear. The bounce produces relief, and the relief is the trap that keeps investors fully invested when the second and more devastating leg down arrives. I'm not telling you that Monday is the beginning of a crash. Nobody can predict that with certainty. What I am telling you is that the conditions present right now, documented by every major financial institution, measured by every credible economic indicator, and confirmed by the past positioning of every professional money manager surveyed, are identical to the conditions that preceded every major market decline in modern history. The VX, Wall Street's own fear gauge, closed the week at approximately 24. During call markets, it sits around 14. At 24, the options market is pricing in daily moves of 1.5% or more in the S&P 500. That is the market itself telling you that the professionals expect Monday to be anything but normal. And here's what makes this particular Monday different from any Monday in recent memory. The market just absorbed a Good Friday data release while the Iran war escalated, while private credit gates expanded, while hedge fund positioning collapsed, while the recession probability model sat one tick below its perfect accuracy threshold, while consumer confidence cratered to levels below every recession entry point since 1980, and while the people running trillions of dollars raised cash at the fastest rate since a pandemic paralyzed the global economy, all of those forces converge on a single opening bell. The pattern that plays out in every major market disruption is always the same. The data arrives, the professionals reposition, the public hears reassuring words, the public believes the reassuring words, and then the reality asserts itself. The reality right now is an 8% decline from January highs, a CAPE ratio at its second highest level in 150 years, a recession model one tick below its 100% accuracy threshold, oil above $100 with no clear path to resolution, consumer sentiment at multi-year lows, institutional cash hoarding at pandemic levels, hedge fund leverage that just produced a multi-standard deviation blowout, a labor market that is being propped up by strike returners and healthcare hiring, while every other metric deteriorates, and a Federal Reserve that cannot move in either direction without making something worse. This is not a prediction about what will happen. This is a description of what has already happened and what it means for the compressed, volatile, pent-up trading session that begins Monday morning at 9:30 Eastern. The people who navigate these moments successfully are never the ones who wait for permission to take it seriously. They are the ones who see the data, understand the mechanism, and act while the window is still open. The Bank of America survey respondents with $589 billion did not wait for a cable news anchor to tell them the environment had changed. They moved in January. They accelerated in February, and by March they had executed the largest defensive repositioning since a pandemic shut down the global economy. The jobs report that landed on Good Friday was not just a data release. It was a catalyst dropped into a system that was already loaded. The question is not whether Monday will be volatile. That is guaranteed by the mechanics of how delayed data interacts with a fragile market. The question is whether you understand the forces at play well enough to be positioned before 9:30 Monday morning, rather than reacting after the fact. Every person who preserved their wealth through Black Monday in '87, through the dot-com collapse, through 2008, through the pandemic crash of 2020, every single one of them made the same choice. They chose to act on the data before the crowd, not after, not when it was convenient, not when it felt safe, before. The data is in front of you right now. The institutional positioning is documented. The economic indicators are published. The valuations are measured. The risk is quantified. And the market opens in less than 48 hours. What you do between now and then is entirely up to you. But let me leave you with one final observation. The S&P 500 was down 4.6%. After the first quarter of 2026 in the history of the index, when the market has declined by 4% or more in the first quarter, the remaining 9 months have gone in both directions. Sometimes recovery followed. Sometimes the decline accelerated into something far worse. The distinguishing factor was not luck. It was not timing. It was the external environment. And the external environment in 2026 is uniquely hostile. A hot war in the Middle East, the most expensive oil since 2022, the highest tariff rate in 94 years, a frozen central bank, a consumer drowning in 21% credit card debt, a private credit market gaining billions in redemptions, a recession model, one data point from its perfect track record threshold.